This just in, a financial bombshell that could shatter the credit card industry and put billions of dollars back into the pockets of American consumers. Former President Donald Trump has just called for a radical one-year cap on credit card interest rates, a maximum of 10%, effective the day he would potentially retake office. This isn't just policy. It's a declaration of economic war, and it could change everything. We are breaking down this stunning development right now. To understand why this proposal is so explosive, you need to understand the landscape. The average credit card annual percentage rate in the United States right now is hovering near a record high. We're talking over 24%. For people with less than perfect credit, rates of 29, even 35% are common. This didn't happen overnight. It's the result of decades of financial deregulation, the repeal of usury laws at the state level, and a banking system that profits enormously from revolving debt. What is usury? Historically, it's the practice of charging excessive, exploitative interest on loans. Many religions and ancient legal codes condemned it. In America, for much of our history, states had strict usury caps. But a 1978 Supreme Court decision, Marquette National Bank v. First of Omaha Service Corp., was a game changer. It essentially said a bank could export the interest rate rules from its home state to borrowers anywhere in the country. Banks flocked to states like South Dakota and Delaware that scrapped their usury limits. The cap was effectively gone. Enter Donald Trump. This is not his first foray into populist economic rhetoric targeting Wall Street. During his 2016 campaign and presidency, he often portrayed himself as a dealmaker who could shake up the establishment. But this proposal is arguably his most direct and aggressive attack on a specific financial sector. It comes as he seeks to galvanize his base with stark, simple messages about economic relief. The date, January 20th, is no accident. It's Inauguration Day. He is framing this not as a mere policy suggestion, but as a day one action item for a potential second term, creating a clear, dramatic stakes for the election. So, what exactly has been proposed? Based on the statement and subsequent clarifications from his campaign, Donald Trump is calling for a federal, temporary cap on credit card interest rates. The cap would be set at a maximum of 10% annual percentage rate. It would apply nationwide, superseding all state laws. Crucially, it is framed as a one-year emergency measure to provide immediate relief to American families being crushed by debt. The official reasoning, according to the sources, is twofold. First, to combat what he calls predatory lending by major banks that are reporting record profits while consumers struggle. Second, to act as a counter-inflationary measure. The logic is that by slashing the cost of carrying credit card debt, which totals over $1.13 trillion nationally, more household income would be freed for spending or saving, rather than being vacuumed up by interest payments. The immediate reaction from the financial industry has been one of sheer alarm. A spokesperson for the American Bankers Association called the idea economically disastrous, warning it would lead to a severe contraction of available credit. Their argument: banks can't charge interest rates that reflect the risk of lending, especially to subprime borrowers. They will simply stop lending. Credit cards could become inaccessible to tens of millions of Americans. Rewards programs, cashback, travel points, all funded by interchange fees and interest revenue, would likely vanish. Let's look at the key numbers. The Federal Reserve's data is clear. The average APR on interest accruing cards is 24.24% as of the last quarter. For store cards, it's even higher, often above 30%. According to a recent analysis, if you carry a $5,000 balance on a card with a 24% APR, you'll pay about $1,200 in interest in a year if you make only minimum payments. Under a 10% cap, that interest charge plummets to about $500. That's a $700 direct saving for that household. Scale that across the nation's total revolving debt, and you're talking about a seismic shift of wealth from lenders to borrowers. But this story has more than one side. The opposition viewpoint is fierce and comes not just from banks, but from many conservative economists and some lawmakers. They argue this is heavy-handed government intervention that distorts free markets. They say it would punish responsible borrowers by making credit scarce and expensive for everyone, as banks raise other fees or tighten standards to compensate. Some have called it a political gimmick that ignores the root causes of consumer debt. There's also the significant legal and legislative hurdle. Could a president do this by executive order? Most constitutional scholars say no. Setting national usury laws would almost certainly require an act of Congress. The last major federal intervention in credit card rates was the 2009 Card Act, which focused on transparency and billing practices, not rate caps. It passed with bipartisan support. A 10% cap today would face a brutal fight in a divided Congress, making the January 20th timeline seem highly improbable from a legal standpoint. Internationally, eyes are watching. Many developed nations have stronger consumer finance protections. In the European Union, many countries have usury laws, though they vary. Germany, for instance, has a cap typically around 10-12 percentage points above the base rate. Japan has strict limits. Analysts abroad are viewing Trump's proposal as a potential shock to the global consumer finance model, given the size and influence of the U.S. market. If such a cap were implemented, even temporarily, it could inspire similar movements in other countries where consumer debt is a growing political issue. The deeper analysis here is about political narrative versus policy reality. Trump is tapping into a very real and widespread pain point. A recent survey showed over 60% of Americans live paycheck to paycheck, and credit card debt is a primary stressor. By proposing a simple, drastic solution, he is forcing a conversation and putting his potential opponents in a bind. Do they defend high credit card rates? The proposal reframes the debate entirely, putting the financial industry on the defensive and presenting himself as the sole champion of the indebted consumer. Let's get granular. How would this affect ordinary people? The impact would be a tale of two economies. For the estimated 55 million Americans who carry credit card debt month to month, the relief would be immediate and substantial. The hundreds of dollars per month potentially saved on interest could mean the difference between falling behind on rent or catching up, between fixing a car or not, between a modest emergency fund or none at all. It would act as a massive, targeted stimulus for the most financially strained households. However, for another large group, those with lower credit scores or thin credit files, the consequence could be a locked door. If banks drastically reduce risk, these consumers might find their credit lines slashed or their applications denied. They might be forced toward less regulated, potentially more dangerous forms of credit, like payday loans. The very people the policy aims to help could be cut off from mainstream credit. The broader economic implications are vast. Bank profitability would take a direct hit. Major issuers like J.P. Morgan Chase, Citigroup, and Capital One derive huge revenue from credit card interest. Their stock prices tumbled on the news. A sustained cap could lead to layoffs in the financial sector and a pullback in consumer lending that might cool the economy. Conversely, the boost to disposable income for millions could increase consumer spending in other sectors, potentially boosting retail and services. Politically, the ramifications are just as significant. This proposal draws a stark line in the sand for the 2024 election. It forces other candidates to respond with their own plans for consumer debt relief or to argue for the status quo. It energizes a key part of Trump's base, but also has the potential to appeal to working-class voters across the political spectrum who feel economically squeezed. The debate is no longer just about inflation in the abstract. It's about a specific, punishing monthly bill that millions dread. We've been reaching out to economists and policy experts. The reactions are polarized. Progressive economists, like those at the Roosevelt Institute, applaud the move as a necessary shock to a broken system. They argue that for decades, financialization has extracted wealth from the middle and working classes, and that aggressive re-regulation is long overdue. They point out that usury caps were standard for most of American history. Mainstream financial analysts, however, are deeply skeptical. David from Bankrate.com noted, while the intent to help consumers is clear, the mechanism is blunt. The market would react violently. Credit would not just get more expensive, for many, it would disappear. He suggests more targeted approaches, like expanding financial counseling or strengthening bankruptcy protections. Historical comparisons are being drawn to the 1980s usury law changes, but in reverse. Some experts see a parallel to the 2008 crisis aftermath, when there were loud calls for mortgage principal forgiveness, another direct debtor relief idea that was considered too radical at the time, but has since entered the mainstream policy discussion. The consensus forecast among the experts we spoke to? The likelihood of a 10% cap passing as described is extremely low. But the likelihood of this proposal, shifting the political conversation and putting permanent pressure on credit card companies, is very high. We may see voluntary initiatives from the industry or more moderate legislative proposals for tiered caps as a direct response to this political threat. The genie of aggressive rate regulation is now out of the bottle. Key takeaway: this is more than a policy. It's a political earthquake for the consumer finance industry. Whether it becomes law or not, it has instantly made credit card debt a top-tier election issue. Watch for how other candidates respond. Watch for any movement from major banks who may offer preemptive concessions. And watch January 20th, it's now symbolically charged as a day of potential financial reckoning. For continuous, in-depth analysis on stories that impact your wallet and your world, subscribe to Kenya News Update today for more breaking news.